A leader has to take the risks.
John, what's up, man? How you doing?
Hey, man. I'm great. How are you doing today?
I'm doing fantastic, man. I'm doing fantastic. You know what? I was just charging my ear pods, so I'm going to throw those in real quick. If you can,
all right,
excuse
sounds
me
good. Yep.
So Eastern time. Where are you located, man?
Yeah, I'm in Cincinnati.
Cincinnati, okay.
Yeah.
And what's up in Cincinnati? Were you born and raised, or?
No, man, I'm from Cleveland, but I'm a Midwest kid. I was born in Cleveland, raised in Cleveland, went to school in Dayton, moved to Detroit, moved to Chicago, and met my wife when I was in college. We went to Detroit, Chicago, and eventually, once we kind of got settled and had our kids and they started to get to school age, we decided we wanted to be closer to family and moved to Ohio, moved back to Ohio, and her family's here in Cincinnati, so that's where we moved.
Well, that's quite a story, man. A lot of moving around in your life, huh? I mean, so good
Yeah,
thing you're in the multifamily unit business, man. You know how to
yeah, man.
move yourself around, huh?
I've stayed in a lot of apartments.
You stay in a lot of apartments, man. So,
Yeah.
well, I mean, in fact, first of all, thanks for coming on Wealth on the Beach
Yeah.
podcast. You're a general partner in like 100 million in multifamily apartments. Is that correct?
Yeah, we've been a general partner in over $100 million worth of real estate, all apartments. We actually we did one hotel deal too, which is not included in that, but yeah, mostly apartment buildings.
And so, how did that all begin for you, man? I mean, give me a little bit of a history on that, how that started for you.
Yeah, so our journey is probably not that dissimilar from most other people. I mean, we were in corporate America, having our W-2 job and wanted to earn some money on the side and try to figure out how to build wealth and how to have financial freedom and all that kind of stuff. What happened though is, I kind of talked about my travels, but when I was in Detroit, I was working for GM. I was working for, at the Renaissance Center headquarters, and that was in 2007. So I was there from 2007 to 2011. In 2008, of course, is when the market started to turn the other way and we had our big market collapse and GM went through bankruptcy. So I watched not just, myself, but my peers, my coworkers. I saw the impact it had on everyone. And a lot of folks lost their jobs. We had a lot of layoffs. We had a lot of demotions. And I just remember, just being filled with anxiety. And in particular, there were two things that jumped out to me, or two people. One was a guy who had worked there for 23 years. He's what we call a lifer. His plan was to work there, retire there, get his gold watch, get his retirement, get his pension set, right? That was his plan. 23 years in, he got his papers. He didn't have a plan B. He didn't get the golden parachute. He didn't get any of that stuff. He didn't have a plan B. And he left a voice message on everyone on our floors inbox, talking about how he was impacted and how distraught he was and how he didn't know how he was going to pay for his medical needs. And I remember feeling a great sense of empathy for him, but also saying, I never want to feel like that. I never want to feel like I don't have any power over my situation and giving so much of that power to a corporation, a big corporation at that, right? It's one thing to work for a small startup. You kind of expect that it might struggle and have some issues, but you work for a large corporation, you expect that company to be pretty stable and provide that stability for you and your family. And I was young and didn't have kids or whatever. But that was one guy. There's another guy though, who throughout all that anxiety, all those challenges, this guy came to work happy every day, smile on his face, chipper, joyful. Everyone else is anxious, scared. And this dude's always got a smile on his face. And his name was Jack. And I would always talk to Jack because he'd always make me feel good. He was a little bit of an older guy, but had just great energy. And Jack, one day I just asked him, I said, Jack, hey man, everybody else comes in here looking miserable. You come in happy every day. Like, what's the secret? And Jack laughed and he said, well, John, part of it is I don't need this job. He said, I've been investing. I own real estate in Colorado. I've got some stuff here. And he's like, I do this because I enjoy doing it. I need something to do. I enjoy doing this. So that's why I come to work. But I don't need the check. like my life doesn't change whether or not I get paid twice a month from this company or not. And that was the first time I really understood passive income. The first time I really understood the power of wealth creation through real estate. And that was really the spark, and it took me a minute to figure out how to take that insight and put it in action. But like, I think that was the moment I said, that's why people invest. Got it. The tale of two extremes. And in short, I wanted to invest in real estate, but again, I was in Detroit in 2008, and not exactly the best time for a new investor to look for deals and stuff. So it took me a while to get started, but shortly after we moved to Chicago, and part of that journey was us buying a duplex. We bought a 2-unit building, lived in one unit, rented out the other, which people call house hacking now. We bought a 3-unit building, bought an 8-unit building, and we slowly started to scale from there.
And so what was it like? Was it multifamily unit that you just like? Did you have a mentor? Did you learn from somebody? Like, why did you choose multifamily versus, say, what a lot of people do is they just go buy regular houses?
Yeah, so a couple things. So yes is a short answer to everything you're saying. I educated myself big time. So while I was in Detroit, and once I kind of made that mental shift, and one thing I didn't mention was I had read Rich Dad Poor Dad years before. So when I was talking to Jack, a lot of what crystallized for me was looking at the guy who had spent 23 years of his life dedicated to this company with no plan B, looking at this other guy who already had his investments and could care less what really happened. I mean, he cared, but it wasn't going to change his life. So that took me back to Rich Dad Poor Dad. And this was the real life manifestation of that in this corporate world. So for me, that was to say, okay, we need to be more like Jack and take advantage of investment opportunities. How do we do that? We got to educate ourselves. We got to read more books. I mentioned the Rich Dad book. He had a second book called that was the ABCs of Real Estate Investing by Kim McElroy. Read that book. So I read as many books as I could read. I started to there weren't really as many RIAs, so Real Estate Investment Association meetings at that time. So I did look up some, but I couldn't find any. Podcasts weren't out yet, but I did start networking a little bit and talking to other people who I knew owned real estate. I started telling my colleagues, hey, I'm looking to invest in real estate. Do you know anybody? And they're like, oh, such and such owns a condo. Great. Happy to talk to her, right? And the short is everybody I talked to who did own real estate, particularly who had scaled a portfolio, they all said they wish they had started or moved to multifamily sooner. So after hearing that multiple times, I just said, okay, well, if everyone keeps telling me this, why don't we just start with multifamily? And we started small multifamily, residential, 2 to 4 units, but we started there for that reason. The other thing is once I moved to Chicago, Chicago has a plethora of 2 to 4 units. So when you're in that city, most of them are, 2-unit buildings. So it's easier to find and buy 2 to 4 units than it is to even buy a single family house, at least on the north side of Chicago where I lived.
And so that was the direction. That's how you kind of made that happen. And so tell me, I'm just kind of curious because I mean, you seem like a really intelligent dude, well spoken. And tell me a little bit about your childhood. I mean, what kind of kid were you growing up? I mean, did you come from a rich family? Did you come from, really educated parents? Were they college educated? Were you college educated? I mean, like, tell me a little bit about your childhood.
Yeah, no to everything except me being college educated. So I grew up um so my parents split when I was young. I was probably like 5 years old when they split, right? So I kind of grew up in this 2 different homes. I spent Monday through Friday with my mom. Friday nights my dad would pick me up, and I'd spend the weekends with him. So I was blessed to have present parents even though they weren't together, but neither of them really had much money. So I learned a lot about money just from trying to figure out why we didn't have money. And I think one of the things that's always key is, you know my stepmother told me that. She said, a lot of adults spend their entire adulthood trying to fix things that happened in their childhood, right? So if you grew up and you didn't have certain things, you kind of frame up your adult life to address that. One of the things I tell people is like when you talk about success, well, success to me is defined by each and every person by themselves. And one of the ways I define success for me is about being a present father. And part of the reason I say that is I felt like I had to raise myself a lot. And it's not to say that my parents weren't there or anything, but my mom worked, there was times she worked two jobs. She had to do the thing. She told me very clearly what her expectations were. I knew I had to follow and meet those expectations, but that was it. I came home, I was by myself for about 3 hours every day when I came home, right? I had to cook for my sister at times. I had to do stuff. There were times my mom came home and we looked at each other and said, "What's for dinner?" And she was looking at me like I was hoping you was gonna figure it out, right? So I kind of learned to be independent at a fairly young age. I was a very shy kid, kind of a sick kid, went to the hospital like 50, 60 times, according to my mom. I don't believe that's true, but it has to be. She keeps telling me. But I had asthma. So I had very severe asthma at that. So I felt like I couldn't do a lot or didn't have a lot of opportunities, either financially or just because of health reasons. So I had a somewhat sheltered childhood. So as I kind of grew into my teenage years, I started really finding my independence, finding my voice, and kind of developed more of a fighting spirit. I think I always had it, but I've really identified with kind of the underdog, right? And the various stories of that and overcoming the perseverance. So for me, as I got into my teenage years, I started to understand what success was, started to look for it, started to seek it out, wanted to read biographies and watch, documentaries about success and people who are successful. And what I was looking for was trying to understand why them and why not me. Like, and at first I thought there was a secret everyone had, right? And I will tell you, it's funny because there's only one story that I recall that I really saw someone do something that said, "Yeah, I would never do that." And it was Sean Combs, and it was him taking the train every day from DC to New York for an internship that was unpaid for 6 months. And I was like, yeah, yeah, he's crazy. I wouldn't do that. But everything else felt pretty practical. It was like, oh, go work out every day, or hey, go play basketball for 3 hours, or hey, I, do this. I'm like, okay, if you really wanted that, I could like you can invest that. And it just made success more attainable to me. So I think that was the big thing. And for us, without having people went to college, my best friend, his parents went to college. So I just looked at that, like, how do they live versus maybe how I grew up? I remember asking my dad one day why he didn't read like the Wall Street Journal or watch like, CNBC and all those kind of shows. And my dad's a blue collar, hardworking American, right? He's worked in factories. He was not investing in stocks and all that stuff. And he kind of looked at me. We had a quick conversation. And I think for him, it epitomized like the difference from a generation standpoint. Like my dad's a fairly young dude, but he is definitely like that that previous generation. He is you get a good job, you work it 30 years, you retire. Like that's his mindset. When I quit GM, he almost blew his lid, right? He was so bad and disappointed. We had conversations, but he didn't understand my vision. He didn't understand the way I viewed the world and viewed corporate America. He saw it as you got this good job, you got good perks, you got a company car, they pay you well. Why would you quit? And he thought it was very risky for me to go out to a smaller agency and become more entrepreneurial. He called me a pencil pusher. I mean, it's just one of those things. But I think ultimately you have to have your own vision and you got to seek it out because there's answers out there. You just have to figure out where they are and who to connect with, and you have to be willing to expand your circle.
And you were willing at that age to seek out the information. I think that's what's key for a lot of people. That I've done 250 podcasts so far, and it's interesting because there's not a lot of secrets in success anymore because the information is just out there. I mean, everybody's sharing their knowledge. Everybody that is winning right now, they want to share their knowledge, and it's cool to have stud like you on podcasts like this because you're able to share your wisdom. And look, you took what most people would consider a pretty tough childhood. It reminds me of me, by the way, a lot of my situation. My parents were divorced at a young age, and my mom worked, and my stepdad worked a lot, and so I'd take care of my brother, my younger brother and sister, which were like 10, 12 years younger than I was. So I was in charge of doing all
Yeah.
kinds of stuff. Me and my older brother, we were in charge. I mean, during the summertime, while all the other kids were playing, we were babysitting, trying to have some fun at home and doing stupid crap at home. But we were like taking care of little kids. I mean, that's crazy if you think about it, right? I mean, I was like 10 years old babysitting my little brother and sister. They were like 3 years old, 4 years old. I mean, that wouldn't even be acceptable today, right?
Yeah.
But I think that just like you, the winners, they decide to use these situations as fuel for their fire so that they can have a better life, for their families and for their future kids, and so I just like, when you're evaluating, because I think when people think about real estate or multi-unit properties and different things like that, it becomes very complicated. So how do you evaluate a property? I mean, if somebody was to say, I want to do that, I want to start creating this, side passive income, where do you start? Like, what's step number one? And maybe go through a couple of steps for us to maybe internalize.
Well, I think the first thing is you have to understand your why. And I know that may sound cliche and all that kind of stuff, but what I mean is the goal is not to own apartment units, right? No one, like, that's not going to make your life any different. What you're really shooting for is a lifestyle or time. You want to be a better father, a better husband. You want to be more present. You want to have money to do whatever you want. You want to be able to quit your job. You want to be able to take vacations, right? Those are the real goals, right? Is to enjoy life a little bit more with the people you love. On our website, our phrases, our tagline is passive income to pursue your passions. So I say start there, because you have to then create the strategy and the tactics of investing to help you along the way. A mistake I made investing was knowing I wanted to build a real estate portfolio to get me all of that, but I didn't think about the strategy and some of the negative consequences that came with it. And what I found out was I signed up for a second job. So I had a full-time day job. I had 2 kids who were in diapers, and I'm trying to, grow my multifamily portfolio. I'm flipping some houses. Well, guess what? After work, I had to go to the property, make sure the contractors did what they were supposed to do. I'm checking in on them. I've got to go and analyze some deals late at night. So I'm burning, both sides of the candlestick, and I'm exhausted. So I'm not a great father. I'm not really a great husband because I'm so tired. I don't have time to really engage with them. Spending maybe an hour a day with my kids at that point. So and the irony is I'm doing all of this because I want to be a great father, right? So I think we have to start with the goals, because once I actually stepped back and looked at the situation, I realized I just wasn't taking the right approach. And again, it's easy to say, okay, well, hey, once I hit this, then I can do that. Hey, I can be a better father. I can do this once I hit that. And the goal always moves. It always moves. So you have to make your values a priority. And if you can do that and you are clear on what your real outcomes are that you're looking for, then you can pick the right strategy. So how do you actually get started with apartments? It depends on, again, how much time you have, how much flexibility you have, how much capital you have. I think there are 3 easy ways to start investing in multifamily apartments. One is you can house hack like I did, which is buying a 2 to 4 unit, live in 1 unit, rent out the others. It's not cheating, but it's a great way to get started because you need a place to live. If you're young enough or flexible enough in your current situation, it's a great way to go out there, get a property. You can get FHA financing as little as 3.5% down. You have 1, 2, 3 other tenants that are going to pay your rent. You're typically going to do this in a neighborhood you would want to live in anyway. So you're going to have like-minded tenants. You're not going to be in some of the rougher areas because you probably don't want to live there. So you're going to have people who want the same kind of things. I remember the first place we bought that we house hacked, my tenant actually made more money than I made. It's kind of crazy. I'm looking at it, I'm like, oh, wow, this person could absolutely buy a house. I don't know why they're renting with me, but she wanted the flexibility. I'm like, okay, great. So that's one strategy to get started. The second thing you can do is you can JV or partner with someone. So if you have some capital, find somebody who's got time, find someone who has some experience, and partner with them on a deal. That's another great way to get started. Now, obviously, when you talk about a partnership, that comes with, different challenges, and you got to, get to know somebody and have a good operating agreement and be clear on who's going to do what. But that's another good way to get started. The third way is to invest passively. So that's what we do with our apartment deals, right? We work with everyday professionals who want all the benefits of real estate investing, all the perks of owning multifamily apartments, but they don't want the headaches of being a landlord, right? You don't want to deal with tenants. You don't want to deal with property management. You don't want to show units. You don't want to deal with repairs. You don't want to deal with any of that, but you want all the perks that come with it. That's what we do. We partner with busy professionals. We pool our resources together. We take on all the responsibility of finding the deals, analyzing the deals, managing the deals, hiring and firing any vendors that we need, and overseeing the asset. So we run it like a business owner. We're hiring vendors. We're going to hire employees. We're going to run it. And then ultimately, our investors are our shareholders. So they're going to partake in all the benefits and get all the perks. They're getting a K1, so they do have direct ownership. So it's great for them, but they don't have the responsibility of actually managing the asset. So I think those are the three ways I would suggest anyone get started. Either look to, buy a 2 to 4 unit that you can live in yourself and rent out. You can partner with somebody else, or you can invest with a group like ours. There's certainly other ways to invest, but I don't suggest those if you're getting started because you have zero experience, right? And the reality is you may feel more comfortable saying, well, I don't want to work with other people. If I'm going to fail, I'd rather fail by myself. But you have zero experience. So you're most likely to fail because you have no experience in what you're doing. It is the most risky approach to doing anything, right? Most people in any other world, you would want to partner with somebody who has experience, lean on their experience. And then as you're getting more comfortable, as you're learning, then you branch out into your own and do your own deals if that is what you want to do. And with what I'm describing, you can do it that way. You may get into it and realize you have no desire to actually own real estate, but you like the perks. So you keep investing passively. But if you get into it and you realize you hate real estate, but you already own it and you still got to deal with these tenant phone calls in the middle of the night, that's going to be a miserable experience for you. And it's going to make you feel like you're actually not on the path that you were hoping to get on.
So it sounds like I mean, I'm sure you know Grant Cardone. I mean, it sounds like Grant Cardone is fund. Are you similar to that or different? You know, his Cardone Capital. I mean, is it similar to that strategy or that process, or are you different? And how are you
Yeah.
different?
Yeah. So it's similar in the fact that the business model is the same. I think there's always a bunch of nuances and different approaches. So, he does something very, very different in the types of properties he's looking for. But what we're doing is called syndication. And that's exactly the same thing. There are lots of groups that do it. But syndication is just the act of pooling investor resources together to go out and buy a property. So that's what we do. For us, we work together. Investors get to look at the assets. You get to understand what our business plan is. You get to talk to me directly to understand what we like about the deal, ask me any questions you have about the deal, and decide for yourself if it's a good fit for your investing goals. But that is what Grant does with Cardone Capital. He has a bit of a different approach that he does, so we don't necessarily do it that way. But at a high level, yes, it is a similar approach when it comes to syndication.
Can you tell me a couple of the differences?
Yeah. So first of all, you have to look at what you're investing in. So we like B class properties. B class properties meaning properties that are affordable and desirable for most people, but not luxury. When you're in the luxury space, class A, really, really nice. Think, Miami, Florida, or somewhere like that, where it's really nice, really expensive. You're competing with more people. You're competing with new developers. You're competing with home ownership. You're competing with a lot of different options there for those residents who may just decide that they don't want to rent anymore. They want to go to the next place that came up down the street that has a brand new jacuzzi or whatever it is, right? So you're constantly competing with that. The margins are slimmer because typically they don't cash flow as well, so you're really banking more on appreciation, which to me is more speculation. So we like to focus on cash flow first, upside / appreciation second. Some of those class A assets, they're quality assets, but they don't make a lot of money because there's less cash flow available on those assets. So that's one of the things. What and I don't know what Grant does completely, so I can't really speak to that. But I know that they acquire their assets and then they kind of typically syndicate after the fact. We syndicate upfront. There are pros and cons to it, but we like to go in together with our partners. So we're buying the asset. You're going to know what we're paying for the asset. That's a part of the thing. We're buying this asset for $15 million. We're going to raise $4 million, $6 million, whatever it is. Here's what our business plan is. All that's very transparent and clear. And you're going to see that. So that's kind of the way we approach it. We like growing markets in the Midwest and the Southeast region. So we're in the Carolinas, we're in Atlanta, Georgia, we're in Louisville, Kentucky, we're in Cincinnati, we're in Florence, Kentucky. So we like these kind of, blue collar type towns, but growing. And I think that's a key distinction. We're not talking about Rust Belt type stuff. We're not talking about markets that are declining. We like growth too. We want to see that appreciation. We want to see that upside, but we don't want to be in volatile markets. I don't want to be in a market where it's super hot and we're crushing it, but something bad happens and that market's going to come crashing down. We like dependability, we like predictability, and that's kind of what we look for in our market. So for us, it's a strategy thing. We're also a smaller operation, so we can be pretty lean. We don't have to do a certain number of deals every month or every year to cover our payroll. We are pretty lean in the way we operate, so we can be flexible and just take advantage of opportunities that make sense for us.
And what sort of returns? I mean, obviously, there's nothing guaranteed future results,
Yeah.
but I mean, what type of returns are we looking at getting maybe from a syndication such as yours?
Yeah, most syndication deals, they tend to mention comparable returns. What we've seen up to this point on our exited deals, we've averaged an IRR of 19%. We typically see between a 6 to 8% cash on cash return annually. Now, again, this is, there's no guarantee that will continue, but that's what we've seen up to this point. Typically, when we're looking at a deal or analyzing a deal, we want to see that I can deliver a 6 to 8% cash on cash annually when it's stabilized. And we do want to see about a 14 or 15% IRR when we sell the asset. So that's kind of what we project to and what we analyze. Another way of thinking of it is if we were to hold the asset for 5 years, we want to be able to double an investor's money. You invest 100K, we want to be able to get you back 200K. It's not guaranteed. Again, if we deliver a 1.75 return, I think that's pretty solid, but we'll kind of let you know where we feel each deal is at, and we try to manage it as best we can. The market's going to do its thing, so we try to do our best to mitigate our risk. And that's another thing I love about multifamily is we've got leases that change out every month. So I just had an asset management call with our team and one of our Louisville assets, and one of our things in the business plan is, hey, we've got a big turn season coming up. We've got about 15 leases over the next 2 months that are coming up for renewal. We're going to be pushing rents pretty substantially on those assets. So that's what we're working on there. And it allows us to kind of stay real time with the market versus, if you've got something where your lease is already baked or you don't have the ability to push rents or react quite as quickly to the market, maybe you don't get a chance to take advantage of, that rent growth that you're seeing.
And minimum investment, what is that typically with you guys?
Yeah, it's typically 50K is our minimum investment. Some investors go up to maybe $250,000. I would say for your first investment, you should probably look at around 50 to 100. As you get more comfortable with whoever you're dealing with or working with, you can feel free to invest more. But most people invest between 50 and 100 on their first deal with us.
And as far as time frame, what sort of time frames are you looking at to exit deals, or are you just kind of thinking you're going to cash flow it as long as I mean, is there a certain sort of equity line cap that you're looking at trying to exit?
Yeah, so we're typically looking at a 5-year hold. That's what we analyze too. With that said, I think it's really important to understand not just the business plan and kind of the projections, but also understand, what happens if something changes. It's easy to go in with a projection or a plan, but where's the risk at? What can happen if something changes? So I'll give you a great example. Interest rates just shot up big time over the last year. So for some deals, that could be very problematic. So one, I want to know, how are we mitigating our risks against something like that? How also might that impact our business plan? Could that accelerate our timeline? Where we say, hey, interest rates have shot up. Maybe this is an opportunity to sell sooner. Or will it extend our timeline? Hey, interest rates have shot up. Maybe there's less demand. Maybe we can't get the number we want today because someone won't be able to get the loan they want today to pay the number we want to get on the exit. So we may need to hold the asset a little bit longer. So you want to just understand things like that. The way I look at it from my standpoint is my role is to maximize returns for investors, but only after we preserve their capital. So capital preservation is the very first thing we're looking at. You invest with us, I'm going to give you all your money back. I want to make you a return and a profit, and we certainly strive for that. But my obligation is to give you your money back. Not to lose your money is the number one thing we're looking at. So we're looking at the deal with that lens in mind, first and foremost, but we also want to grow it and be advantageous. So flexibility is key. We want to be able to respond to the market. We want to sell when it makes sense to sell. Sometimes it's going to be at 5 years. Sometimes it's going to be at 3 years. Sometimes it's going to be 7 or 8 years. So again, as long as we have some flexibility built into our plan and we have ways of being flexible, which is typically comes down to the long terms. If we have that, then we can decide to sell when it makes sense, and we try to communicate that as best we can to investors so that they're aware, they know what we're thinking, they know the variables we're paying attention to, and it helps them be better investors on other deals that they may want to do as well.
And as far as like taxes are concerned, I mean, is syndication a good way to mitigate taxes? I mean, are there, strategies that you've used through the years to
Yeah,
lower your taxes?
yeah. Listen, tax benefits are one of the main reasons investors look for syndication deals. It's one of the best ways to reduce your tax obligation. So there's something called depreciation. There's another thing called bonus depreciation, which allows you to fast forward and take all the depreciation at one time. So this is something that is passed along to all the investors in a syndication deal. And I have people ask me all the time, well, what's the difference between like a syndication and a REIT? Like, why not just invest in a REIT? This is one of the main reasons. In a REIT, all of that has already happened, and you're not a direct owner of the actual real estate. So you don't really get that benefit directly. When you invest in a syndication, you are a direct owner of that company. So you're getting a K1, just like if you own shares of a business. Now, the caution is you have to have passive income to be able to take the passive losses, or you have to qualify as a real estate professional. So a strategy a lot of people do, especially if they're a married couple and maybe one person is a high income earner, the other person is maybe a stay-at-home parent. Well, that stay-at-home parent can become a real estate professional, get their license, work 750 hours, and then those losses can be applied against both of their incomes. So if you have, let's say, a high net worth doctor who's making $400,000 a year, and you have a spouse who is, a real estate agent, and they put in 750 hours. Let's say they invest $200,000 in a real estate deal. They might get a paper loss, meaning a K1 that says they lost 160 or $170,000, maybe $150,000, just to be a little more conservative. If they get $150,000 paper loss, you can take that against that $400,000 income. So now instead of paying taxes on an earned income of 400,000, you're going to pay it on an income of 250,000. So you can see how this can be very attractive for those investors. And I'm not a CPA, I'm not a professional there. I do talk to a lot of them all the time, but I would advise you to talk to your tax professionals. And if they don't know what I'm talking about, go talk to more tax professionals, because you need to find people on your team that can help you reduce your tax liability and grow your income. And I will just say this too. Some people may think of it as a loophole. It's not a loophole, it's an incentive. The government wants us to invest in housing because they suck at it. Government housing, no one wants to stay in government housing. I promise you. I grew up not super rich. I didn't do in government housing, but we didn't have a lot of money. I promise you, nobody wants to be in government housing. You don't want them controlling that. So the way they try to incentivize investors and entrepreneurs is to say, if you create jobs, if you create housing, if you take care of some of these things, we will create some tax breaks and some incentives for you. So don't think of it as a loophole or not doing your civic duty. I know there's some people who take advantage of loopholes and different taxes, but this isn't one of them. This is an incentive for people to put their money in things like real estate, in things like businesses, creating jobs so that we can keep spurring growth in the economy.
Yeah, that's a really good point, because a lot of people, they get a little bit scared about, well, wow, I'm going to save all this money in taxes and I'm going to be taking away from the government. And now we can't pay for, different, government agencies or whatever. The challenge is that they're thinking about this thing completely backwards instead of thinking about it as a bad thing that people are saving money in taxes. I mean, it's how I became financially independent, really. If I think about how quickly I was able to do it, I got there because I was able to save so much money in taxes that allowed me to grow my business even faster, which allowed me to save even more money, which allowed me to grow my net worth even faster to get to financial independence. The biggest expense that all of us incur is taxes generally, and especially for middle America. You're talking somebody making $100,000 a year, they're giving away close to half of their income to taxes in some cases. And so, and we're not even talking about taxes like when you fly on an airplane, you got to pay taxes and sales taxes and every other tax that the government is throwing at us. And I tell people all the time, if you don't pay attention to taxes, it's like you're taking your money, which nobody would ever do this, but you're taking your $100 bill and you're throwing it on the ground and you're burning it. So you're throwing away money when you don't pay attention to taxes. Like you said, you go talk to a great CPA and you say, how can I mitigate my taxes? I mean, this is everything. Not to mention, not just with the syndication, but if you're actually buying multifamily properties, I mean, there's so many tax benefits. I mean, you're writing off every expense that you're making. Not to mention when you go travel and you look at different properties in other states, or you do whatever traveling to be able to try to expand your operations. All of that is a write-off. The things that you're buying for these properties, the things that you're, the education. I mean, I know you do a lot of educational conferences and speaking and things like that. I mean, people pay for self-improvement stuff so that they can learn and get better. Or books, they go and buy your book, or they go and buy, something like that. These are all expenses that you can write off when you have businesses, which being in real estate is just like you being an entrepreneur, being in business, that they're able to take advantage of. Most people just never think of these things. Are there any other, situations that you've been able to take advantage of when it comes to taxes through the years?
Yeah, I mean, there are a couple other things, and I think to your point, there's the write-offs, there's reducing your tax liability, there's travel, like you mentioned, there's not just, on flights, but there's also car. If you're driving to your property, you're driving to do different things, you can certainly, write those things off, meals, all those kind of things. I know some folks I was actually at a mastermind last night, and they have some Airbnbs, and they have an LLC for that Airbnb. So they have to do a company meeting every year. Well, guess what? They fly down to that Airbnb. They have a meeting down there at that location, and they're able to take all that and write it off as, and obviously it's a place that they're going to go vacation and enjoy. But that entire trip, they can write off as a corporate retreat or a corporate meeting. I'll say this though, the write-offs and all those things I think are what flashes and gets people excited. There's actually some meat and some sustainability to this as well. And it goes back to, what are you contributing to society? Because entrepreneurs and real estate investors contribute to the economy. We are creating jobs, we are creating opportunities, we are driving the economy. And when you talk about what you've been able to do, you've had to employ people, right? Even if it was just, hey, I'm hiring somebody to edit this podcast, right? But you had to pay people. You've had to, take on services, hire vendors. So you are helping to spur the economy. As real estate investors, we're hiring property management companies, we're hiring contractors, we're hiring roofers, we're hiring leasing agents, real estate agents. There's money that's moving because we're doing something. We're providing housing, we're doing all of these different things, and that keeps it going. And when we talk about the role, if you just have a W-2 job and that's it, you're not creating jobs, you're not creating money to flow, you're just a spender. That's when you get taxed at the highest tax bracket. These incentives we're talking about are there to help us take on some of the burden of creating jobs, creating the flow of money, and driving the economy. And that's what's really important. And I think sometimes people lose sight of the role that entrepreneurs and business owners have. I mean, you can feel however you want to feel about big companies, but the reality is those big companies pay people salaries and they keep things moving. And small companies can do the same thing. Entrepreneurs and small businesses are the backbone of this country, but you have to recognize that, and real estate investors are a part of it. And I think sometimes, unfortunately, they get a bad rep, and people don't really understand like why these breaks are there is because we're actually driving it. If you just collect your W-2 check, but you're not, you know, helping someone else, you know, create a job, or you're not paying someone's salary, you're not hiring different vendors and services, that's what's not contributing to society. And that's why they tax them at the highest taxable amount.
Well said, man. Well said. Setbacks, failures, challenges. Tell me.
Lots of them, man. You know, I think the biggest one, I kind of alluded to it earlier, but not realizing that the strategy I was employing didn't really match up to my values. You know, I talked about being a present father as one of my goals. And there was a day, this is actually in a 3 unit. There was a day I got a quote to paint, you know, one of the units, and it was crazy high. I'm like, y'all crazy. I'll do it myself. Well, doing it myself, I saved the money, but I wasted an entire Saturday. And I had no idea how long it takes to paint by yourself to do a really good job. And it took me like 8 hours to paint this entire unit by myself between, you know, prepping the wall, priming it, first coat of paint, let it set, let it dry, second coat of paint. Oh Lord. I was tired, and it was like it was summer day, and I had a, you know, small child, and my wife's with them at the park, and she's sending me pictures, and I'm like, so to be clear, your goal is to, you know, have this passive income so you can spend more time with your family. Yet here you are on the weekend at this apartment by yourself painting while your family's at the park. Something ain't adding up, man. And I had to just, you know, again, reevaluate what I was doing and what my strategy was. And that's why the larger apartments actually make so much sense. It may feel counterintuitive, but when you have a house or a duplex, you don't have enough cash flow to hire people. So even if you have a property manager, it's like you and that property manager, but that property manager isn't there every day. When you have 100 units or 200 units, well, now there is enough cash flow to have someone on site. You know, that person works at the property 5 days a week. And that makes it easier to run it like an actual business where you don't physically have to be there. I just got off an asset management call right before this, and I'm talking to my team. I'm not there, I'm at home, but I get to talk to them. What's going on? I went over all the numbers. How are we trending? What are we looking at here? How's our leasing? How's our showings? Okay, hey, I think this metric is up. This is great. This one's a little bit down. What are we doing to fix it? But I can run it like a business. And I come from corporate America. I was at GM. I was at advertising agencies. So this is my skills, taking a look at the data, putting together a plan, and helping execute that plan. It's not being on site and painting, right? I'm not wasting my time picking up a paintbrush and trying to paint this unit. I'm running the business, and there's enough money to have a professional property management company, to have professional vendors, to have people who can come in and run the day-to-day of the business. And that scale is really important. So for me, the failure was trying to do it all by myself, trying to save money and be efficient, but not allowing it to create the lifestyle that I was really shooting for or reinforce the values that I say are my values. And values aren't real values until they cost you money, right? Until it costs you money, it's not really a value. We can all, or it costs you something, you know, we can all say, you know, we value being fit, or we value this or that. All right, well, if you value being fit, are you going to eat that cheesecake? Well, I value a great cheesecake too, right? So, I mean, when those values conflict, that's when you know what your real values are. So when it's, do I miss my son's birthday, or do I go to this work meeting or this work event that I need to really go to? Well, I value being a great employee. I might value being a reliable entrepreneur, but obviously I value being a great son, right? But when those conflicts of our values come into place, that's when we have to make those tough choices, and we learn what our real values are. And most of us don't recognize that when we're in the moment, but that's the truth. The truth is, if you go to that event, you value work more than you value, you know, being that present father for your son. And I had that happen to me. And that was a moment where I said, you know what, we've got to really push this business because I'm I have to miss my son's birthday to do this shoot because I didn't have anybody else who could cover it and who can go. And my values were in conflict and they weren't aligned. So I had to make adjustments so that I could really prioritize my values and keep the things that are important at the highest level.
Yeah, as an entrepreneur, I think everything changes when you decide that that you're going to run it like a business, like a real business. The CEO of the major corporation
Yeah.
is not out there painting the wall, right? I mean, at some point in time, you got to look at yourself and you got to go, okay, I'm going to have an abundance mentality. It's abundant thinking. It's saying, okay, I am hiring somebody. Yes, it's less money for me at this present moment, but I'm hiring somebody. So therefore, I have extra time either to take care of the values, go play with my kid, or go get another deal, or go work on something else that's going to bring in even more cash flow than the $15 an hour you're paying the guy to paint the wall. And so, yeah, it all changes, I think, for because our audience who we're speaking to right now are mainly small business owners, young entrepreneurs. These are people that they say they want a great life. They say they want freedom, choices, and options. Well, they're going to get that when they decide that they're going to run the business like a business and not like a little spare time little thing that you're doing on the weekends. And I think that's when your mindset changed. Correct me if I'm wrong, but your mindset changed when you said, wait a minute, I have to pay people to do this other crap so I can go get more business, so I can build it bigger, so I can go create more freedom, so I can create more time, so that I can really align my life with the values that I came here, like to create, like my why. This is why I did it. And that's, I think, when things change for you. And so you have a podcast. Well, first of all, you have a great voice. You have an amazing, like you should be on the radio or something, but you do have a podcast. So you kind of are on the modern radio. Tell me about your podcast, man. And what do you guys talk about there?
Yeah, the show is called Multifamily Insights, and we just released our 500th episode. So we've been doing this for a little while now. So we're excited about that. But the show really is to help both real estate investors as well as aspiring real estate investors understand some of the benefits and perks of investing in multifamily. And we cover everything from, what to look for in a deal, if you want to be passive, if you want to be more active and kind of run your own deals, how to do that, how to scale, how to attract capital and partner with other people. So we cover a lot of those different tactics. When I launched the show initially, it was called Target Market Insights. And the show was all about how to find the best places to invest, because this is something that I was struggling with. I didn't know the difference between, this part of town or that part of town. And you would talk to investors, and I was in Chicago at the time, and I was looking to invest in Cincinnati. And I would talk to people, and they would say, "Oh, you want to be on the west side," or someone else would say, "Oh, you want to be on the east side." It's like, why did that person say the west side and this person say the east side? And how do I decipher the difference between the two for myself? So that show initially launched to help me navigate those things and figure out what was really important versus what was just noise. So that's what the show kind of gets into, a little bit about markets, a little bit about, again, investing, a little bit about strategies. But I think it's a great podcast. It was actually ranked #1 real estate podcast by, I don't know the guy, but he ranked a bunch of podcasts and put mine #1. So I thought that was really cool. But nonetheless, it's a great show. We've done 500 plus episodes, and it's available anywhere you listen to podcasts.
Well, congratulations on that, man. That's quite a feat. 500 episodes. Imagine the type of information, everybody. I mean, imagine the type of information you can get. Imagine the things that you can learn. And he doesn't even charge for his podcast. It's free information. You go on iTunes and Spotify, and you could listen to the wealth of knowledge of this dude, John Casmon, right? Is Casmon? Casmon. I wasn't sure if it's Casmon or Cas, but it's Casmon, right?
I don't know. It's funny. I talked to my dad and my grandfather about this, like when I was a kid, and they both said it differently. So I just chalked it up at that point. So I'm like, no one knows.
No one knows, man. It's all good, John. You're an amazing John. So look, I just know that for everybody that's watching, listening, go out and say hello. Hit him up on his Instagram. He's got an Instagram. Give us your Instagram. Give us your YouTube. Give us your podcast. Give us all your information so we can connect with you.
Yeah, I mean, so the easiest thing, if you're remotely interested in apartment investing, is go to our website, casmoncapital.com/sample deal. There you will get to see what a sample deal, and again, it's not a real deal, it is a sample deal, but you'll get to see what a sample deal could look like. And it's helpful because you can start wrapping your head around terminology, terms, returns on the investment, what the deal structure looks like, the equity split, all those kind of things. And then I give you a follow-up with some things that we look for and things that you should look for whenever you're evaluating a deal. Even if you want to be active and do your own deals, it's great for you to borrow. I have people call me all the time or tell me all the time, like, yeah, man, I downloaded your sample deal, stole half the stuff so I can frame it up, and that's what I use to share. I'm like, great, man, that's what it's there for, right? So feel free to take it, and hopefully it can inspire you a little bit. If you do want to reach out to me on social media, on Instagram, J Casmon is my handle. So just my first letter J and then Casmon, Casmon. I'm also pretty active on LinkedIn, so you can find me there as well.
Yeah, that right there, everybody that's listening, I'm telling you, this is the right kind of mindset, because I want to make sure you understood what he just said. He just said that he's giving out a wealth of knowledge, massive amounts of valuable information and content, which is what everybody should be doing, by the way. This is abundance mentality. This is what I've been talking about, is give it away. It's okay. The universe will always bring you enough. The universe will always bring you as much as you need. And so the truth is yeah, some people are going to take the information and do it themselves. That's cool. But also the other truth is that most people are going to say, I don't want to do it by myself. I want to invest with this dude that knows what he's talking about, has done it 100 million times worth, and might as well just work with somebody like that and get a really nice return on my money without having all the headaches, without having all the people, the renters, and having to deal with all the contractors and managers and leasing people and all these different, situations. Might as well just have somebody do it. Again, if you're not prepared to go all in and do it the right way, and spend years and years of hitting the books and going to the seminars and running around the streets looking for properties and all that stuff, if you're not prepared to do that, then you might as well work with somebody that's going to do it for you. And so I think that's what John's able to do. And man, this has been so much fun. I really appreciate your wisdom and your time, John. What an incredible story of just coming from where you came from to creating an amazing life of freedom, because I know you have a decent amount of freedom in your life because you built wealth and you built passive income, and this is what we all strive to build. And you did it, man. So congratulations to you. You're a huge inspiration to a lot of people. You should be so dang proud of yourself. And we're rooting for you all of the way. With that said, everybody, make sure you continue to dream bigger than ever. Get after it, but most importantly, do it now. God bless you. We'll see you at the top.